In the meantime, Goldman Sachs is kicking off its 24th annual Alternative Summit today. Dignitaries from a wide range of industries will headline sessions at the event, including former Secretary of Defense General Lloyd Austin, former Treasury Secretary Stephen Mnuchin, former UK Prime Minister Rishi Sunak, Yale University Professor of Psychology Laurie Santos, and many other names. For more on that summit and the capital markets and much more, we want to bring in David Solomon. He, of course, is the chairman and CEO of Goldman Sachs. And we should mention that David is also a member of CNBC's CEO Council. David, it's great to see you. Thanks for coming.
Thank you. Thank you for having me. It's great to be in the studio. It's been a while since I've been in the studio with you guys, so it's good to be in the studio.
Really nice to have you here.
Thank you.
Alternative assets. You've been doing this for 24 years for this, but now alternative assets are everywhere. There's a lot of talk of this because of what the Trump administration has done with saying that it's going to be available for people's 401ks. What's happened? What's the evolution? What do you see right now when it comes to alternative assets?
Sure. And first, thank you for highlighting the Alt Summit. We're excited about it. We've been running it for a long time. We have about 450 LPs that are here. We obviously have a very scaled alts platform. We manage or supervise over $500 billion of alts across private equity, private credit, infrastructure, and real estate. And so we've been doing this, as you said, we've been in the alts business for more than 30 years. But the growth of private capital formation continues. And, candidly, I still think we're in the early innings of private capital formation when you look at the scale of it. I think it's very constructive for markets. Obviously, some of the private capital formation is also a response to the regulatory structure, particularly when you look at private lending and private credit. And some of that, in my opinion, is going to get rebalanced out, in the coming years. But it's important, and I think one of the strengths of the U.S. economy is that we have the most robust capital markets and capital formation system in the world. I was just in Europe last week, and, it's a completely different ecosystem. You don't have the risk-taking, you don't have the participation of retail investors and the stock market broadly. And so the private capital formation ecosystem here is a very powerful driving force for the strength of the U.S. economy and something we should all support.
Those alternative investments have historically been for wealthier investors, and there's the one take on it that, hey, everybody should be able to get access to this. The reason it's been a little more limited to individual investors is that sometimes these are pretty illiquid investments. And what does that mean for somebody who doesn't have a lot of liquidity or other things to fall back on? What do you say to people? How much should you have before you get invested in some of these things? What are some of the wariness, some of the concerns people should have?
Well, we certainly let investors speculate in lots of things with a lot of latitude.
More so lately.
That I think with a long-term view, certainly can be, riskier than a diversified portfolio that includes some alternatives. I think, like everything else, there's time and place. Time and place matters, and I think about it appropriately. I have children that are in their 30s, and I think about their retirement accounts. An allocation of 20 or 25% in the retirement accounts, where they're really putting money away for 30 years and they don't need that liquidity. I think that makes a lot of sense for somebody that's working hard, is saving, is building a retirement. I think that makes a lot of sense, and so we are going to see more access to these products in a variety of different channels that allow investors to participate more. Whenever we do things like that, there are people that push too far, or there are practices that develop, and those are things that should be watched and, need to be managed appropriately.
I'm thinking your kids have a really good future. For some,
I'm very.
You're saying generic 30-year-old children. You're not talking about David Solomon.
I'm very proud of my kids. They are working away.
All right,
they're independent.
I think they're.
Somehow they
going to be.
They
good.
popped out and they're doing great.
David, one of the things that I think about, though, is the private assets. The whole private world obviously uses sort of a different disclosure and transparency policy than public assets, and we're putting effectively those private assets in the public markets in this sort of unique way. And whether you think there should be either guardrails or different sort of auditing techniques or other things. I mean, one of the things about the NAVs of all of these funds is, to a large degree, they are being maintained or decided by the fund managers. And I wonder, once you get into a public market space, whether they really need to be provided ultimately by some kind of third party or even fourth party that are somehow independently verified as we sort of get into a different place with all of this.
Well, I think you're raising a couple of things because private companies do have different reporting standards, although there are lots of private companies at scale that report the same way they would report, if they were a public company. That's different from valuation metrics against private investments and how private investments are valued and how those marks are moved over time. So I do think as there's more exposure of these products to broader markets, this is something that'll get discussed and debated, and I think it's an appropriate thing to think about. One of the reasons why I think that the activity, if we look at private equity in particular, that the activity or the monetization of the broad cut of private equity assets has been slower is because in 2020 and 2021, a lot of those assets were marked up.
Right.
The values actually declined below the marks, and the marks didn't necessarily follow. We've now been through a period of a few years where those businesses have been growing back into the marks. So the industry, that is something to think about.
But the industry would say that's a bug, that's a feature, not a bug, right? That the idea that you can actually hold those assets at a marginally different valuation than the public markets, that you're not marking it to market all the time, is actually a feature of that piece of it. I'm not arguing that's the case. I'm saying that's what they would tell you.
I think like most things,
you're a mark-to-market kind of guy.
I think we've been a mark-to-market firm in a lot of ways for a long time. I think it depends on the context. So that's fine if you're in something that's truly illiquid,
right?
Okay, and you don't have any liquidity option for years and years and years. If you are offering some sort of liquidity, a percentage of liquidity, whether it's on a quarter basis or an annual basis or something like that, then the actual value that's delivered when people look for liquidity matters, and then the marks become very important. So I think generally speaking, it's prudent to mark things for what they're worth and where they can be sold. There are others that would disagree strongly.
You're not guaranteed of doing well. I just, for the heck of it, went on AI and said, as Harvard dug itself out of its illiquidity PE mess that its endowment got into,
there was no bias in that prompt to the AI agent, was there?
It didn't go like this. It came up with a no immediately that Harvard has not yet dug it. And this is how far back does that go?
That was pre-financial.
Yeah, just before the financial crisis, and they're still got, I don't know, 40, way too much, and they still can't get out.
There's no question the ability to monetize these investments over the last 5 years has been slow, but that's been a choice on the part of the managers, and that's reflective of the incentive system that basically they have a long-dated option to keep compounding the value.
If Harvard can't do it, should individual investors be expected to?
I think there's a time and place. I think there's a time and place for everything, but I think when you look at these products, you have to think carefully about time horizons, liquidity, and you really have to understand. But we certainly allow individual investors to invest in lots of things that carry a greater degree of risk if you're not factoring in liquidity.